From 50% win rate to profit, the one simple shift that changed everything. Here's something that's going to sound completely backwards. A 50% win rate is enough to make you consistently profitable in trading. Not 70%, not 80%, not some mythical 90% win rate that the gurus on social media pretend they have. 50%. Flip a coin. Heads you win, tails you lose. If you structure that trade correctly, 50% is enough. Now sit with that for a second, because if that's true, and I promise you it is, then everything you've been obsessing over might be the wrong thing entirely. Most traders are killing themselves trying to be right more, hunting for higher probability setups, filtering and refiltering their strategy until they're barely placing 5 trades a month, convinced that if they could just win more often, the money would follow. But here's what nobody tells you about that pursuit. Winning more often is not the same as making more money. And I know that sentence just broke something in your brain a little. Good, hold that feeling. Because when you really understand what I'm about to walk you through today, you're going to look at trading and maybe your entire relationship with success completely differently. This isn't a video about a magic indicator. It's not about a secret setup or a hidden strategy. It's about one shift, one realization, one change in how you think about every single trade that transforms a break-even trader into a consistently profitable one. Let's go. Reality shift. Let me ask you something honest. When you lose a trade, what's the first thing you ask yourself? Most traders ask, why did that trade lose? What did I miss? How do I avoid losing that trade next time? And that question, as logical as it sounds, is slowly poisoning your development as a trader. Because it assumes the wrong thing. It assumes that the goal is to stop losing trades, that losses are failures to be eliminated, that a losing trade means something went wrong. But in a game of probabilities, which is exactly what trading is, losses are not failures. They are expected outcomes. They are the cost of doing business. They are built into every edge that every profitable trader in history has ever had. The common belief in trading is this: better analysis leads to more winning trades, and more winning trades leads to more money. That belief is incomplete, and that incompleteness is costing you. Here's the truth that changes everything. Profitability is not about how often you win. It's about how much you win when you're right versus how much you lose when you're wrong. That ratio, your average win divided by your average loss, is called your risk-to-reward ratio. And it is, without exaggeration, the single most misunderstood concept in retail trading. A trader with a 40% win rate and a 1-to-3 risk-to-reward is more profitable than a trader with a 70% win rate and a 1-to-0.8 risk-to-reward. Don't just read that, do the math with me. Take 10 trades. Trader A wins 4, loses 6. Each win is $300, each loss is $100. Total, plus $1,200 from wins, minus $600 from losses. Net profit, $600. Trader B wins 7, loses 3. Each win is $80, each loss is $100. Total, plus $560 from wins, minus $300 from losses. Net profit, $260. Trader A wins less, makes more. If you've never truly felt that math in your gut before today, let this be the moment it lands. Shift 1. From chasing win rate to protecting reward. Here's where it changes. The moment I stopped asking, how do I win more trades, and started asking, how do I make sure my winners are bigger than my losers, everything shifted. Not overnight, not in one trade, but structurally, at the level of how I approached every setup, every entry, every exit. The whole game changed. Old behavior. Taking profit early because you're afraid the trade will reverse. letting losses run because you're convinced the market will come back, celebrating a winning week with a 70% win rate without noticing your average win was smaller than your average loss. New behavior, defining before you enter exactly how much you're risking and exactly where your target is. Then respecting both, letting the trade breathe to reach the target, taking the loss cleanly when the stop is hit. Measuring your week not by how many trades won, but by the net R value of your trades. This isn't just a strategy adjustment, it's a psychological overhaul. Because cutting winners short feels like safety, it feels responsible. Your brain says, take the money before it disappears. And every time you do it, every time price keeps running after you exited, that sting teaches your nervous system to be even more fearful next time. Meanwhile, letting losses run feels like patience, like you're giving the trade a fair chance. Your brain says it'll come back. And every time it doesn't, every time you take a massive loss on a trade that should have been small, you're being billed at premium rates for your emotional avoidance. Here's the psychology behind this. Humans experience losses roughly twice as intensely as equivalent gains. This is called loss aversion, and it's one of the most well-documented findings in behavioral economics. Nobel Prize-winning research, not an opinion. What this means for you as a trader: your brain is biased, structurally, biologically biased towards cutting wins and holding losses. You are wired to do the exact opposite of what creates profitability. The consistent trader isn't someone who escaped this wiring. They're someone who built systems to override it, who removed as much discretion as possible from the exit process, who made the target and the stop non-negotiable before the trade started and then held themselves to that commitment. The goal of a successful trader is to make the best trades. Money is secondary. Alexander Elder. Think about what Elder is saying. The best trades aren't necessarily the ones that win. They're the ones executed correctly, where the risk was defined, the reward was respected, and the plan was honored. Here's a thought to sit with. What if every trade you cut short was actually a vote against your own consistency? Let me tell you about a trader I'll call Dio. Dio had been trading for 2 years, decent win rate, around 55%. But he was barely breaking even, some months slightly up, some months slightly down. He couldn't figure out why his strategy wasn't working. I asked him one question: what's your average winning trade versus your average losing trade? He didn't know. We pulled up 6 months of data. His average win, 0.7 R. His average loss, 1 R. He was risking 1 unit to make less than 1 unit, and even with a 55% win rate, the math was slowly bleeding him dry. He hadn't changed his strategy, he hadn't switched indicators. He just started cutting his winners the moment he felt anxious. We fixed one thing. He committed to a minimum 1.5 R target on every trade. Nothing else changed. Within 3 months, the same strategy, the same win rate, he was consistently profitable. One shift, that's all it was. Imagine becoming the kind of trader that doesn't need to win every trade, because when you win with purpose. Shift 2. From emotional exits to structural exits. If the first shift is about understanding reward, this one is about protecting it. Because knowing you need a 1 to 2 or 1 to 3 risk to reward is one thing. Actually staying in the trade long enough to get there is an entirely different battle.
Let me be honest with you. Most traders don't fail at finding entries. They fail at managing exits. And not because they don't understand the theory, but because exits are where emotion is loudest. When a trade is going in your direction, the feeling is electric. You're watching the price move toward your target and your brain is screaming at you, take it now. What if it reverses? That voice is not your intuition. That voice is fear wearing the costume of wisdom. And when you listen to it, when you close that trade at 1R because you were afraid of losing the unrealized profit, you have mathematically undermined your edge. Even if the trade never hit your target, exiting early was the wrong move if the plan said otherwise. Old behavior. Moving the target closer after entering a trade, closing at half the target to secure profits, telling yourself you'll let the rest run, and then closing that too 30 seconds later. Watching price hit your original target after you've already exited, and feeling a complicated mix of relief and frustration. New behavior. Setting the target before entering, then treating that target as a commitment, not a suggestion. Not watching the trade in real time if your psychology can't handle it. Trusting the analysis you did before emotion was in the room. Here's the psychology. The version of you that analyzed the chart before entering the trade was calm, logical, systematic. The version of you watching price move in real time is emotional, reactive, and scared. The question is, which version of you should be making the exit decision? The answer is obvious, and yet most traders let the scared version drive. The shift is structural. It means making your decisions before the emotion exists, setting hard targets, using alerts instead of staring at charts, building a process that removes the emotional version of you from the exit conversation as much as possible. This is what professional traders mean when they talk about trading your plan. It's not a motivational phrase, it's a literal instruction to honor the decisions made by your logical self and to not let your emotional self overwrite them mid-trade. In trading, the most important organ is not the brain, it's the stomach, the ability to hold the position and tolerate discomfort." Unquote. If you've felt the discomfort of watching a winning trade pull back before pushing to target and you closed it anyway, drop a comment saying, "I've been there." I want to know how many of you recognize this moment, because it's not weakness, it's the most human thing in the world, and recognizing it is the first step to transcending it. Imagine becoming the trader who sets the target, closes the laptop, and checks back to see the result without needing to watch every tick in between. That's not indifference, that's trust. Trust in your process, trust in your analysis, trust in yourself. I want to go back to a specific period in my own trading. About 1.5 years in, I was at a point that I now recognize as the most dangerous stage of a trader's journey. I wasn't blowing up accounts anymore. I wasn't making catastrophic mistakes. I was just hovering, grinding. Some weeks up a little, some weeks down a little. Net result, almost zero. It felt more demoralizing than losing money fast, because at least when you're losing fast, something is clearly wrong. You can identify the problem and fix it. But breaking even, that limbo state, gives you just enough hope to stay and just enough frustration to slowly lose your mind. I remember printing out my trade log one Sunday afternoon. 60 trades, laid them out on the kitchen table like some kind of detective building a case. And that's when I saw it. My winners averaged around $95. My losers averaged around $130. My win rate was 52%. I did the math 3 times because I didn't believe it. I was a slightly above average coin flipper who was paying more when he was wrong than he collected when he was right. Of course I was breaking even. Of course. The math didn't lie. I was just too focused on whether I was winning to notice how much I was winning. I thought back to every trade I'd cut short. I could picture specific ones. The EUR-USD trade where I'd exited at 15 pips because it looked like it might reverse, and it ran another 40. The GBP-JPY trade where I'd moved my target closer after price stalled for 2 candles, and then it pushed clean through where my original target was. Every time I'd had a story, a rationalization, a reason why this time taking less made sense. What I didn't have was data. I didn't have the humbling knowledge that the version of me making those in-trade decisions was operating at a fraction of my actual analytical ability. I was letting fear make choices that deserved logic. So I made one rule, just one. Every trade I take must have a minimum 1 to 2 risk to reward target. If the chart doesn't offer that, I don't take the trade. And once I'm in, the target does not move closer. It can move further away if price gives me a reason to trail, but never closer. That rule was simple. Following it was not. The first week, I closed 2 trades early out of habit. I caught myself, noted it, didn't beat myself up, just acknowledged it and recalibrated. The second week, I let one trade run all the way to target for the first time in months. Price pulled back twice on the way there. My stomach turned both times. I didn't close it. It hit the target. And the feeling wasn't joy. It was something quieter than joy. It was confirmation. It was proof that the plan worked when I actually followed it, that I could trust myself. By the end of the month, the results were different, not dramatically, but meaningfully. The same win rate, roughly, but the net result was positive, because when I won, I was collecting what the trade was worth. I hadn't become a better analyst. I hadn't found a new strategy. I had simply started respecting the math that was already there. That's the shift. That's all it was. And it changed everything. Shift 3, from measuring wins to measuring R. This is the shift that ties everything together, and it's the most invisible one. Most traders measure performance in dollars. Up $200 today, down $150 yesterday, had a good week, made $600, had a bad week, lost $400. And dollars feel real. Dollars are tangible. But dollars as a performance metric are almost useless because they don't account for risk. Making $200 on a trade where you risked $50 is completely different from making $200 on a trade where you risked $400. The outcome in dollars is the same. The quality of the trade is radically different. This is where R multiples come in. R is simply the amount you risked on a trade. If you risk $100 and make $250, that's a 2.5 R win. If you risk $100 and lose $60 because you exited before the stop, that's a negative 0.6 R loss. When you start measuring in R, everything becomes comparable. A trade where you risked $50 and a trade where you risked $500 are now on the same scale. You can look at your results and see the quality of your trading, stripped of the distortion that position size creates. Old behavior, checking the dollar P&L obsessively, feeling good about a $300 winning day without knowing you risked $250 to get there. Feeling devastated about a $200 losing day without recognizing you only risked $80. New behavior, logging every trade in R, reviewing weekly performance in R, setting growth targets in R. Understanding that a plus 2R week with 3 losing trades can be better than a plus 1R week where you won 8 out of 10. Here's the psychology. When you measure in dollars, your brain anchors to arbitrary numbers that mean nothing in isolation. $200 profit feels great if your account is small, average if your account is large. But 2R profit is 2R profit, regardless of account size. It tells you that your winners are doubling your risk. That's meaningful. That's measurable. That's a standard you can hold yourself to. Switching to R-based thinking also does something deeper. It removes the emotional charge from individual trades. A 1R loss isn't $100 gone. It's the expected cost of one trade that didn't work out. It's been budgeted for. It was planned. It doesn't mean something went wrong. That reframing is not just semantic, it physically changes how your nervous system responds to losses, and that calmer response is what allows you to stay consistent. You don't need to predict the market, you need to manage risk and let the math work. Van K. Tharp. Van Tharp spent decades studying what separates consistently profitable traders from everyone else. His conclusion wasn't the strategy. It was the position sizing, the risk management, and the understanding of expectancy, which is just a fancy word for what R-multiple thinking gives you. Here's a question to reflect on right now. Be honest with yourself. Do you know your average R-multiple for the last 30 trades? If you don't, that's where to start. Not with a new strategy, not with a new indicator, with the data that's already in your trade history, waiting to tell you the truth. Imagine becoming the trader who doesn't need a great day to feel good because they're measuring the right things, and the right things are trending upward.